YouTubers! Mike Martin's here, Mike Martin's channel, bringing you another update on the markets. Dow plunges 1,100 points, bringing its decline from a record high to more than 10%. Guys, this is actually a big deal. This is yesterday's article, but it was updated today about an hour ago, and I kind of want to throw this out there because of this. So there's a Dow Jones Industrial Average daily point drops. So Monday, this is when it hit hard. Tuesday, that's what you got, right? Wednesday, I thought things were going to kind of somewhat plateau or kind of maybe not regain, but kind of stabilize for a while. And then Thursday, boom, boom, boom. Today, 1,190. Yesterday during the show on trends in the housing market, last night, here it is, I was actually proposing towards the end, let me see if I could find it here, towards the end of the show, that we were going to see basically the market was going to open 400 or 500 points down. That's what I said. And I said VIX was going to be up, which it was. And also gold will stabilize and find its floor, and which I think it does. It's around the 1650 mark, around that much. So there it is right there, guys. We're looking at this. So it goes on to say right here, watch this. On Wednesday, evening of the first of U.S. CV case of unknown origin in Northern California, indicating possible community spread of the disease. The patient had no travel history or contact that would have put the person at risk. CDC says on Thursday, California Governor Gavin Newsom said the state is monitoring 8,400 people for CV. Look at this. Apple, Intel, and ExxonMobil were among the worst performing Dow stocks Thursday, dropping at least 6 points. They're the biggest losers, right? AMD, Navidad fell 7.3%, 5.6% respectively. American Airlines dropped 7.7%, and while airlines slid 2.4%, Las Vegas Sands and MGM Resorts meanwhile fell 1.3% and 4.5% respectively. So the press conferences, so here it is. There's the market correction, they're calling it. They're not calling it a crash, but a correction. Here it is here. This is for the last 2-year trend, and there's the 100-day moving average about right there. Last 100 days, and there you see right there, we're starting to see it kind of make a correction. We're going back to November 2019, maybe a little bit earlier right there, maybe right a little bit earlier. So again, pumping in money into the markets, keeping it going, keeping companies that should be going out of business and not using taxpayers' funds to, heck, it's just money printed out of thin air now. I don't think taxpayers could ever pay any of this back because everybody's so indebted to the cause, right? So that's what's happening there. Now, this other article just popped up like a few minutes ago. Here's how long stock market correction can last and how bad they can get. So this was posted an hour ago. There has been 26 market corrections, not including Thursday, since World War II, and the average decline of 13.7%. Recoveries have taken 4 months on average. The most recent corrections occurred from September 2018 to December 2018. The S&P 500 bounced into out of correction territory throughout the autumn of 2018. The S&P 500's close below 3,047. Its current threshold of correction also marked the quickest 10% decline from all-time high in index's history. So guys, here's the deal. If you go back here, I just made a video here for you guys. That's on the Ranson lifestyle. Here it is. Nope. Where'd it go? Right here. Toronto and Montreal trading halted. So they halted Toronto and trading Montreal because it was huge sell-offs, and they're calling it a glitch or some problem in the software. They always do that. It's like a bank holiday, right? In the middle of the week, right? So, yeah. So there's that. So here it says the U.S. stock market fell from its correction on Thursday as investors punished equities in favor for safer assets as anxiety over the spread of potential impact of the CV. Correction is defined as 10% decline in one of the major U.S. stock indexes, typically S&P Dow Jones Industrial Average from a recent 52-week high close. Historical analysis shows these corrections result in 13% decline and take about 4 months to recover to prior levels on average. But there's one big caveat. This is only if it is not to fall into bear markets territory down 20% from a high. If the losses stretch to 20%, then there's more pain ahead and a longer recovery time. So remember, guys, there's a lot of propping happening here in these markets. So here we got actually market correction since World War II. This is a really good one here. This goes back to 1946, just after the war. And you see the corrections in the markets here, how things crawl back and then come back and crawl back and come back, kind of like an ocean wave. If you see that, it's like an ocean wave, up and down with the momentum of the water of the tides, right? So the Dow and S&P each fell 4.4% on Thursday. The Dow lost a record of 1,190 points, and each closed will in correction territory based of their recent record close. The S&P 500 and the Dow are each down more than 10% since Monday and more than 12% each since their respective all-time intraday and closing highs earlier February. So there it is, bear markets since World War II. So you got 46, and then you should have 80 right here. And I remember 90, yeah, but 80 was a bigger one here. That's when gold skyrocketed. And then you got October 2007. Oh, yeah, and 66 too. And then in 72, we're taking off the gold standard right there, right in between here. That's when things started going nuts up here. And then everything came back to earth in the 80s, early 80s. And that's when gold took off, because Richard Milhouse Nixon took us off the gold standard in 72. And then you started seeing a lot of deregulation of the banking systems, kind of doing what they want, and started converting it into a casino up until the Reagan administration had to correct it and raise interest rates through the roof and basically bankrupt half the country, which had to be done. So this is what's happening. They keep printing, and the repo markets did not help at all. The repo markets help maintain companies that should have failed a long time ago. So instead of putting the money in the workers' hands to kind of stimulate the economy and maybe small businesses' hands, I think the U.S. should start looking at creating grants for small businesses more. Good business, solid business plans get sent in. Create grants that have to be paid back at only pay back 50% of the grant. This way, it's better than taking the money and spilling it into like the markets just to keep it afloat. I'd rather give it to the hands of the workers or the hands of potential entrepreneurship. So then this way, they only have to pay back 50% of the loan, but they could really go out on limb and really make something if they have a strong, solid business proposal and everything to back it, like to show that they're willing to do this, right? I bet you there's hundreds, if not tens of thousands of business proposals sitting around desks, sitting around old shelves, ideas that people had. And if the government could put that money in the hands of people that could employ people potentially, that would be phenomenal. I think that would be a great investment for the government, and the 50% payback in 10 years or something like that. They're better off that way. At least they get their money back in 10 years, 50% of it, and they could be taxing the workers instead of having to print money and putting money into the system that doesn't exist in deflating currency, where they could put money into the hands of workers. Let me know what you guys think. I want to know. Am I out of my mind? Am I delusional? This is just the beginning. I think there's a lot more to come. That's why I'm all in metals. I've been all in metals for the last 3 weeks. Strictly metals and junior miners and stuff. Everyone's saying, Mike, you're losing. I'm just down like not even a percentage from when I bought at the drop 2 days ago. I sold at the height on Friday, and then I bought at the drop on Tuesday or Wednesday. I bought back into more gold and silver, and it's just kind of plateauing with the gold and silver miners. So that's what I've been seeing on my end, investing. So I'm not too worried. Gold and silver, I think gold's found its floor, and I think it's gonna. I think bigger companies will start buying smaller companies, and acquisitions start happening in the gold market. Physical gold, physical currency, physical assets. Right. Let me know what you guys think. Thanks for watching, and don't forget to hit the subscribe button.